Okay. Okay. Gary, you're okay. Okay, so the question is, we're here, what would you do? And why?
Steve, I would probably, because of the intraday chart, well, looking at the trade, I would probably go long in there, but it would still be, that hammer kind of tells me I want to go long, but then that next candle closed back into it as like there was a lot of selling pressure right there.
I would buy and use the bottom of the hammer as my stop.
Okay.
Because
I would probably wait for the stock to retrace to the bottom of the hammer or closer to the bottom of the hammer before I go long.
Okay. All right, so we have a buy here, or retrace to the bottom of the hammer. Okay. Ingrid?
Yes, I agree. I would wait until it retraced also.
Okay. And why is that? Why would you wait for it to retrace? I guess the question we need to ask, and excuse me, I just want to get a pen. The question we need to ask is, okay, if you're buying it for whatever reason, what's your risk and what's your target? Okay. So if you're buying on the hammer, if you're waiting for a retracement, what's the idea behind that? Why wouldn't you be buying it here?
Well, I would wait for confirmation.
Okay. And all right, so nothing wrong with the confirmation. Then the question is, whenever we place a trade, think about the risk reward. Okay. So we have the confirmation. You want the market to pull back to the hammer. You get the confirmation. What's your target and what's your risk? Okay. And I'll open up to, I don't mind put anybody on the spot. Gary?
It looks like your risk would be a quarter if you bought it on the candle after the hammer. Mm-hmm. Say bought it on close, you'd have about what?
Lower the hammer, essentially, whatever.
Yeah, the low of the hammer would be your risk, and the high of 62 plus would be your reward. That would put that risk-reward ratio a little bit out of whack to me.
Okay, so if we're buying, say we're risking a quarter.
Oh, I see, yeah.
Right, and it makes 75 cents.
That would be right.
That would be okay, yeah, I think so. Now, why would, what signals do we have at 62? Okay, and what's the resistance? Bearish engulfing patterns, two bearish engulfing patterns, exactly. Okay, so, he said bearish engulfing patterns. So the challenge, now the question is, and this gets to the heart of it, we have a bearish signal and a bullish signal. Do we wait for rallies to short into the bearish signals, or do we go long on the hammer or a retracement of the hammer? Okay, how many say that they should go long either at the hammer or a retracement to the hammer? How many say that? How many say they'd rather go short on a rally to the two bearish engulfing patterns? Okay. There's no really correct answer for this. The way I would look at it, that's why you're paying to see my insights, is why do you think I put the daily chart on? And I have the trend on there. So that we know the trend is up. Okay. Even if you're trading intraday, if you are using 15, 30 minutes and you're going to be in and out in the day, when you're looking at that time frame, you're in the market for a few hours. I would suggest looking at the daily chart to get us into the trend. So go ahead. Oh, hold on. Okay. We only have one mic. Two mic. Okay.
Yeah. I look at a daily chart and I see a confirming support right there. Mm-hmm. Then it tells me that there's a positive trend from being short.
Right.
Then I go in at 60, 50, 66, go all the way up, try to cash. Whatever I see opposing two red candles, it confirms resistance, which is a bearish, all the way down, which was 50% retracement of the whole range.
Okay.
That's use that as an exit. Right.
Right. Okay. So you're looking at 50% here. That's a good point. I didn't even see that. So the way I would look at this is I would go long. I would be perfectly comfortable going long on the hammer because it's such a good risk reward. First of all, you're in the direction of the trend, the prevailing trend on the daily chart. It's a relatively, as Gary pointed out, it's a relatively low risk. It's good risk reward. And it would have worked out. I forgot who said, Ingrid or whoever mentioned that they would wait for a retracement, and that actually happened a couple of sessions after, because this is the hammer. It looked like it's around 12 o'clock. Okay. This is the daily chart a few days later. This was that hammer at 12 o'clock. And see, these are the two bearish engulfing patterns. So the market actually, and it doesn't always do this, you're not always going to get the luxury of a market pulling back and testing the hammers low. As I mentioned yesterday, it does do it very often. But I think even on the first hammer, because it's such a good risk reward, there's been nothing wrong about pulling the trigger. So what we've defined, what we've done is we've gone in the direction of the trend, i.e. the daily chart. Now, if this was our target. I'm sorry, this was our entry. Let's say we bought it even on over here. Okay, and this was our target, and this was our stop. So we were risking this much, a quarter, to make 75 cents or whatever. And this would have been our target. And look what happened the next session. Why would we be out over here? Why would we be out probably on the open? Well, not maybe right on the opening and then start to pull back. You know, you'd say to yourself, well, first of all, we'd want to lock in some profits. Okay? This was, the Japanese say, if heaven drops a fig, open your mouth. That's one of those times. Why would you think we'd be out there? Why do you think I have the daily chart on the left?
It challenged support.
Or resistance.
Resistance.
Yeah, I do it all the time, say support. It challenged resistance, right. A tweezer top, yeah. It's at a resistance area. And we don't know, in the first few minutes of trading if the market's going to break resistance or not. But there's nothing wrong with getting out at a nice profit at a resistance area. And then, for example, if you really wanted to be long again, let it break the resistance. Okay, we're going to look, and Ken mentioned this. He and I have the same reference. Great minds think alike, or the if-then idea. If you want to go long, let the market break resistance. If it breaks resistance, then we can think about going long. And we'll look at the if-then rule in a couple of minutes. So we kind of synthesized, we've put together a few things here. The importance of looking at the longer-term trend, the daily chart, even when you're looking at an intraday, and obviously risk-reward. Okay, check different time frames. You know where the market is coming from. Okay, look at the chart of a higher degree. In this chart, we were trading on a 30-minute basis, but why did we suggest getting out over here? Because we looked at a chart of a higher degree to get a resistance level. Okay. Resistance on a daily chart is much more important than resistance or support on an intraday chart. Yeah, okay. And are we seeing confirming signals in different time frames? I'm a little wary about this last one because you can get so totally confused looking at different time frames because you're going to get different things. But sometimes things really jump out at you. And I'll show you something really interesting on Google in a couple of minutes. So we'll go through these. Now, let's say when intraday, we trade strictly intraday. But even if you do that, again, looking at the longer intraday time periods, 15, 30, and 60 minutes. We trade intraday. We want to be in a position just for a couple of hours. And the market is down here. This is June 26th. And this is a daily chart. We know it held support at the end of the day because we could see it bounce at the red line. But during the day, on June 26th, what happened? What we could do is use support or resistance on a daily chart, important support or resistance, and mentally write that down, or if you can put it on your computer, put a horizontal line on your intraday chart, because what you might find, now this support level is right around 43.25, and on June 26th, that red line is that support area from the daily chart. Okay, this happens to be a 5-minute chart. Right at that support area on the daily chart, we got an intraday, and that's your trading signal. If you're trading intraday, okay, use the time frame you use to initiate the position. Look for a candlestick signal. So right at the major support area, what candlestick signal? Well, it says right there, a hammer. So if you buy it there, you've defined your risk with the hammer. And what would your price, what would a target be? Give me a pattern. Give me a... Okay, some people are saying the top of the window, some are saying high of the window, some saying 50%, the bottom of the window, and the answer is yes. I used to be in politics. It's the whole window. The whole window's resistance, but when I look at something like this, my analysis is your first resistance is there, so that would be my target. Just be conservative. Question?
Can I ask a question, please? And Ken, this is to both of you. I had my trading rig set up such that I was looking at the 1-minute charts vis-a-vis what Ken has taught me, but I also had the same stock broken out in 30, 60, and daily charts, just like you're espousing right now. And I haven't heard a lot of interleave from Ken on, is that also a recommended technique, Ken? When we're doing our intraday trading, having these, 30, 60, and daily minute charts that we can look at on multiple monitors. Is that something you would also advocate during our intraday trading?
Well, a great question. I think it would depend on the length of trade. For example, if you're, and again, experiment and test on what type of trader you are. If you're an intraday swing trader, meaning your positions are from, say, 15, 30 minutes up to several hours, then you would want to use multiple time frames with longer time intervals. But if you're doing quick scalping, we're using, say, a 6-minute round trip, you can't get a signal on using 15-minute candles. So it depends on the type of trading style you have. There's 3 different types. First is a very aggressive short open range. I'm very tight, 8, 12 minutes round trip. So those, by requirement, those need tick charts or 1-minute charts. If, however, you're a trader who's going to have, say, 45-minute or 2-hour, 3-hour, 5-hour positions, then you need to use longer time frame candles as well. Use the 1 minutes on the entry, but use your longer time frames, so you're combining multiple time frames for longer term round trip. So good answer, or good question rather than, hopefully that was a good answer. So, yeah.
Yeah, and that's why we complement each other, with the swing and the intraday. When you're doing 1 to 2 minutes, the trend on the daily chart is really not that important. So it's a whole different mindset. It depends on your holding period. Question?
Yeah, considering here as far as the exit on that, instead of basing it on, say, a resistance level or something, would there be any harm in waiting for a candle pattern to say, hey, it's time to be out of here? Like,
great question.
For instance, a shooting star or a bearish engulfing or something like that. Just leave the exit completely open-ended until such time as the candles told you to get out.
All right, so great question. Do we need to set a target, or can we just wait for a candle signal? And my opinion is you should always have a target, and the reason for that is to get risk-reward, we need risk and reward. What's the only way you can get a reward, a potential reward? Get a price target. You have to have a price target. However, and we'll look at this in a couple of minutes, doesn't mean the price target is set in stone. If we have a price target and we're getting a candlestick signal saying, okay, maybe we're not going to get to the target, a bearish signal, nothing wrong with getting out of it, out of the trade. But to really be, in my opinion, a long-lived, successful trader, we always have to think about the risk-reward. And what that means is getting a target, an initial target. Okay, looking at different time frames. And here we had a doji in Google at the highs on July 21st, and I got an email saying, okay, we had a doji, it might have been Flora, we got a doji, the market gapped down on July 21st in Google. And, is that a bearish signal? And obviously it is a bearish signal. You don't know, it's not a falling window, it's not a confirmed falling window until the market closes. I'm going to show you ways to get an earlier signal, but just based on classic candlesticks. We don't know it's a falling window until the end of the session, because what happens if the market opens here and then pushes through here intraday? Is it a falling window? No. So, great to see a falling window, but by the time we got the signal, the market was a high of 318 and it closed at 302, $16. What I was looking, because I actually happened to be at the trading screen that morning, on July 21st, okay, this is July 21st, that was a Thursday, this is July 21st here. First 2 hours of trading, okay. On the 30-minute chart in Google, bearish engulfing pattern, should be resistance. Another little bearish engulfing pattern. Now remember, Candles don't give you price targets, so the fact we had two bearish engulfing patterns doesn't mean Google is going to go from, 318 to whatever. It just meant the odds of a turn are high. This was a 30-minute chart. This was a 15-minute chart. An evening star. Refresh your memory, an evening star comes after an uptrend. It's a long white real body. Bulls are in charge, small real body, and then a black real body that gets deeply into the white candle. It should be resistance area. Okay. And on the 5-minute chart, we had a series of high wave candles. And a high wave candle, just refresh your memory, is a single candlestick line with a very long upper shadow and very long lower shadow and a small real body. Because what the high wave candle is telling us is, the Japanese would say it's lost its sense of direction. The long upper shadow tells the market rallied during the day or during the 5-minute period, and then by the end of the 5-minute period it sold off. The long lower shadow means it sold off, but by the end of the period it bounced back. So it sells off, it rallies, it sells off, it rallies, it doesn't know what it wants to do. And that's very different. Did the market know what it wanted to do there? Right. Look at those white candles. Okay? The market, there was no lack of directional bias. Then we start getting this high wave candle. The first small clue, the market's starting to lose its sense of direction. Okay, remember what the candlesticks do, give us those potential turning signals as little as 1, 2, or 3 sessions, and then we just echoing more uncertainty. So the trend doesn't go from up to down. What it did was it went from up to neutral. And that's very valuable information. Because then we know maybe to think, if we're long, if we're doing 5 minutes or whatever on a 5-minute chart, if we're long, maybe it's time to take some profits here. I wouldn't go short on this by any means. So we had a group of signals, the 5-minute, the 15-minute, and the 30-minute period, that happened early in the session on the 21st. So you would have gotten the signal probably around up here, actually where the market's open, right around here, rather than down here. So even if you're looking at daily charts only, which most of you don't, I would suggest looking at an intraday, because sometimes you'll get those early reversals. You have the mic?
So Steve, in effect, what I see, I go a lot of times if I'm looking at the stock from a monthly to a weekly to a daily.
Okay.
And you're just working the stock down. You think something's going on there, and you're using the shorter time frame interval to confirm what you believe is happening.
Right. The progression is, whatever time frame you're looking at, I would use a little longer time frame to get to your major support or resistance or your trend. To me, the daily is the most important from a swing perspective. All right. I would always have a daily chart to give me my major support and my resistance, the trend. But yeah, good question.
Thank you.
Okay. Now, one of the things I mentioned yesterday is, and it was very astutely pointed out, we had a tall white real body, and they said, I asked where would first support be, and said the middle of the white real body, and I had mentioned that yes, while the middle of the white real body is potential support, I would always look at a shorter time frame. See, we're focusing on different time frames now to get potential support or resistance. Our goal here is giving you signals, giving you entry and exit points other traders are not looking at. So here, this is a daily chart. It doesn't matter. Let's say it could be a 60-minute chart, but this is a daily chart, and let's say you're using a daily chart to trade. But whatever I say here could be true with a lower time frame. So let's say you're looking at 60 or 30 minutes. Imagine this is a 60-minute chart. Daily chart. Now, we see this daily chart, and we say to ourselves, where's first support? Okay, what's an obvious support area? Forgetting about the middle of the white candle. If you saw this daily chart, or whatever the 78? Yeah, it's a very obvious support area. Now, if I told my clients that the market closed at 82 3/4 and the first support is at 78, that's not going to do them any good. They're not $5 away from where the market is. They need to know support and resistance areas a lot tighter than that. What we do in our advisory service, and we have a daily newsletter, Illuminations, we give 3 levels of support and resistance, S1, S2, R1, R2, and so forth. So.
81.75.
Okay.
Because of the candles to the left.
Okay, so you're saying 81, and what do the candles on the left tell us? Why would 81? So you're saying right around here. Okay, and what do these candle lines tell us?
That there was
Oh.
some support right under that area if you carried that line on across.
Over here?
Yeah, continue on across to the
Oh,
left.
well, okay, if you're going to be looking at, so carry it here, I don't, maybe, is it what you're talking about over here? Maybe.
No, I was actually above that.
Over here? Oh, the resistance, you mean?
Yeah, for
Oh,
resistance.
Right, right, okay. So what Gary's saying is he's looking at this prior resistance area to be new support, all right? And I wouldn't disagree with that unless the market told me I was wrong. See?
Okay, right.
Old resistance becomes new support, all right? And once the market got below it, it's not support anymore.
not support.
Right? The market's always telling us if we're right or wrong. And in fact, from a risk, because one of the things you want to bring out is, you know, risk reward. Let's imagine that the market did this. What's this signal here? The opposite of the hammer? Shooting star. Okay, now the shooting star, and we don't know the market's going to break. Okay? We're looking at the importance of prior support and resistance now. We have a shooting star. The lower shadow is okay. It's a little bit of a lower shadow, but no big deal. A bearish signal. What, we would short, right? How many say yes? Okay. And why would we short? Laura, can you hold the...
You're close to resistance.
over here. Okay, so you're looking at a resistance area here. Okay, well, let's say there's a resistance area. Okay. Okay, another reason why, who raised their hand, they would go short? Okay. Okay. Okay, of course, remember, we're over here. Okay. Okay, so we short because what you were saying? Why would we short?
The previous trend was down.
Oh, the previous trend was down. Okay. Okay, the correct answer is, the first two things you should always do, risk reward. Always. Okay. Tattoo that on your bodies, however you do it. Risk reward. Potentially bearish candlestick signal. If you're selling it here, and again, let's imagine it's held the support here. If you're selling it here, are you selling at support? Reviewing those red horizontal lines as a potential support area. Are you selling at support? Yes. Is that a place to be selling a market? No. Okay? Right. You'd have to break the support first. This is something, again, I just can't emphasize it enough, and it's going to make such a difference in your trading. I don't care how great the candlestick signal is. If it's a bad risk reward, you don't use it. Maybe if it breaks the support area. What we'll do on our advisory service, we'll say shooting star is exactly, I just handwrite all my notes. Shooting star, however, at S1, at first support. If the market closed under the shooting star, it's a bearish, it would confirm the bearishness of the shooting star. Notice I said if the market breaks the support area. I have no way of knowing if the market's going to break support or not. No way. What I do, though, is react to what the market's telling me. If the market breaks support, then I react accordingly. So the correct answer to this is I would not be selling on that shooting star because you're selling on a support area. All right, so getting back to the white candle. So 82 and a half, 81 and 3/4, in my opinion, is not the right answer. So what I would suggest doing is going to a shorter time frame. Okay, this is April 15th, daily chart. This is April 15th on a 15-minute chart. Okay, now when I'm looking at doing this concept on a short time frame, I don't go less than 15 minutes. I'll do 15, 30, or 60. Let me show you. This is April 15th. See a support level on this 15-minute chart? 82 and a half. 82. It's so obvious, but can you see it on this daily chart? So what I do on the service is I go like this. I do S1. I say see attached intraday chart for S1. I put that in. I say 15-minute chart for S1. Okay. Now the reason I don't go less than 15 minutes on this is because it's no big deal if you have 3 or 4 5-minute periods holding support. But if you're having a series of 15-minute or 30-minute periods holding support, it's important. And this is what happened after on the daily chart. And this is one of those, like, I mentioned this at one of my seminars, and somebody said, well, this is like one of those wow concepts. You know, it's something I've always been doing, and I didn't realize that other people don't do it. Because I was always doing this, even when I worked at Hutton in the 70s and 80s, when I was coming up with trading strategies. I thought it was just so obvious. But I've never seen this in any other book, any other technical analysis book. So the idea, just with different time frames, let's say this is an hourly chart, and you don't see any support. Rather than using the middle of the white candle, which I'd use as a last gasp for support, this is a 60-minute chart. Try a 30 or a 15-minute chart, because you may see something. What you're doing is you're getting like a magnifying glass into the inner dynamics of the market. Okay. Convergence. These are all critical concepts, and this is kind of a checklist. You know, you have that checklist of the things we should be looking at. The more technical signals we have joining together, the more likely reversal. So we looked before at a resistance area, which was confirmed by a spinning top or so forth. Western signals to watch include overbought, oversold indicators, and I'll show you some of mine. Volume, momentum, and the force of the trend. You might have your own indicators. I know my clients, my institutional clients, have their favorite indicators. And this convergence of East and West is just so important, and that's why it's really easy. You know, I do, most of my seminars are done for institutional clients, departments, and the reason it's easier to do is because I don't come in and say use the candles instead of. You know, traders have big egos, and they should. Their whole career is based on how well they trade. You know, can you imagine me coming in, hey, you know, use the candlesticks instead of, you know, what your classic Western technicals? What I suggest, and actually what really has to be done, is use them in addition to whatever Western tools you're doing, because you need those Western signals. Two reasons. One, candles don't give price targets, so how do you get a price target? Look at prior highs, prior lows, moving averages. You have to use Western technicals. And secondly, if a candlestick confirms a Western signal, you're getting that convergence of clues. So very quickly on this is real interesting. A couple of years old, but real-world example, how I use the candles in Western technicals, again, seeing the market through my eyes. This was an article that Technical Analysis of Stocks and Commodities did in January 24th of 03. And this is hard copy. I think it's a June issue, but they interviewed me in this date, January 24th. Okay. And they actually wanted me to write an article, but I figured it's easier just to be an interview, you know, so I didn't have to write an article. And this was purely a coincidence, because this was the day at the end of the article, and you could read this. It says, Steve, what do you think about the S&P? Standard & Poor's. And actually, that's my life in a nutshell, right? Standard & Poor. They asked me about what I think about the S&P. And get a little Groucho Marx, I should get a little cigar. People say I look like Groucho, a little bit like Groucho Marx. So they asked me what I thought about the market, and it so happened the close was down there. So I said the market, I'm bearish. And this was the actual quote. I said the head and shoulders target, the head and shoulders top on the S&P gives a target of 775. A close over 870 would void this. And this was the day I did the interview. Classic head and shoulders top, shown by the three semicircles. Market makes a high, then it makes a higher high, and then another high. The first and second highs are lower than the middle high. The dotted line is called the neckline. You connect the lows of the head, you get a neckline. The market closed under the neckline. Okay, that's why I said it was a pure coincidence they happened to do the interview that session. But boom, immediately when I saw that, I then had a target, not based on the candles, based on Western technicals, because what you do with the head and shoulders is you take the height from the head to the neckline, and you take that distance from where the neckline broke. Whenever I talk about a potential trade, I always have a price that says I'm wrong. That's one of the great things we can do with charts. There's always a price that says you're wrong. And that's exactly why I said a close over 870 would void this. Whenever I have a target, I have a price that says the target is null and void. Where did I get 870 from? Classic Western technicals. When there's a head and shoulders neckline, this is really a change of polarity also. The head and shoulders neckline, what should become resistance? The neckline, once the market broke support, and look at this. Okay, I said a close over 870 would void. This was in the state. The market got to 868. The target was still valid. Okay. Then the market pulled back. And again, remember I made this prediction here. And then the market, this was the target down here, right around actually around 775. It was a little lower. It was down here. Okay. So this was the target here. This was actually the head and shoulders target. But the reason I got 775, there was actually a very big bullish engulfing pattern here. And that was right around 775. That's where I got 775 from. And you can't see the bullish engulfing pattern because it's cut off. So anyway, those were my targets. Now, one of the questions was, should we use a candle signal to exit? Okay. And the answer is yes. But notice something. I had a target around 775. See what popped up that told me that we were close enough to the target to say, okay, maybe the target is not going to be reached? The hammer. Okay, and those were the major lows in 03. That was it. So Eastern technicals, the hammer, confirmed a Western signal. The price target was based on the head and shoulders. The break of the neckline was the head and shoulders. The target was the head and shoulders, and the hammer was the confirmation.
How many more clients did you get?
They signed up for a long time. After. Yes.
When you looked at that and you got your price target to the downside, did you looked back to the left for what would be previous support, and that also lined up with your, or what could be previous support also lined up with your price projection target?
Right, right. This is, let me show you. See if we could do this quickly.
Because your price projection was
Yeah,
really close. And
yeah, I'll show you something. Let's see if we could.
it kind of gave you an extra confirmation on that.
Okay, I'll show you. Okay, this is a weekly chart. This is 03. This is the weekly chart. This is the low that hammer made on the daily chart. The reason I was getting 775. Okay, what's that? A hammer. Okay, the lows in 02 were made with a hammer at 775. That's where I got the 775 from. And look how it held here. Now the market moved under the hammer, but did a close under it. Okay? This was the low on the daily chart in 03. That was close enough to the majors. But the reason I got the 775 was looking at a longer term chart to get the major support area. Then what happened, it broke out of the Western technicals, just absolutely classic. Whoops. Okay, the S&P was in the trading, let me get rid of this here. Okay, now let me ask you, because this is interactive. Again, it's an older chart. It doesn't matter. And let me go back a little bit here. What would you do? Talk among yourself for a couple of minutes. We're here. Let's imagine this is a 15-minute chart. It doesn't matter if it's weekly or not. What would you do? Just talk to your neighbors for a minute or two. Would you buy? Would you sell? Would you go long? Would you get rid of the trend line here? Whoops. Okay. Okay, we're here. Okay, we're here. Okay, let's go a minute or two. Then we'll go to this side. Here. Okay, so what would you do? Okay, let's go. Ann? And we could take, if you could take the microphone. Would you buy, sell, or stand aside?
I would stand aside. If it broke that resistance that became support,
Right.
I would, maybe go short. But where it is right now, I don't see a reason to do anything.
Now, don't we have some negative signals? What do we have here?
Yeah, you have a doji,
Doji, and what do we have here?
bearish engulfing,
Bearish engulfing pattern. What do we have the day before the bearish engulfing pattern?
shooting
Shooting
star.
star. So why don't we go short?
You have support right below.
Right, exactly. And the old resistance area, and this is where, remember, one of the things I said is that even if the market breaks support or resistance, remember where the prior levels were. This old resistance became support. So if you're going to, even with those bearish signals, we would say to ourselves, if, and I think Anna had mentioned it, if the market broke that support level, then we'd go short. The importance of looking at prior support and resistance. And then actually what we did was we just took this trading range from 775 to about 975, just rounding it off. And in classic Western technicals, you take a box range, you break out, add 200 points to the breakout, and as soon as the market broke above 975 here, my target was 1175, 1160, and we got there about a year later. And that forecast was based on Western technicals. So let's take a 10-minute, quick question, yes? Go ahead.
Every time I look at consolidation, look at it as a battlefield.
Right.
Especially confirming near support and resistant areas.
Right.
And wait for a confirmation for a breakout and go with the winners.
Right,
Absolutely true.
right, that's
Thank you.
right, yeah. Right. Good. Okay, we'll take a break and we'll reconvene at 9:55.